You know, in the world of tax, the game has completely changed. What you might have thought was hidden, well, it can now be sitting in plain sight. Today, we're going to walk you through a special briefing put together by the experts at My Tax Accountant. They are right at the cutting edge of this stuff, and they've laid out exactly how HMRC is now using some seriously powerful technology to trace wealth. Let's dive in and see what they've uncovered. Just think about that for a second. That amazing trip you went on, the new car, that watch you treated yourself to. All the things we love to share with friends online. But have you ever stopped to think about who else might be watching? Because here's the thing, HMRC isn't just looking at your tax returns anymore. Nope, they are now connecting all the dots to build a complete picture of your life, and they're using AI to do it. The team at My Tax Accountant has broken down exactly how this all works. So, first up, let's talk about HMRC's high-tech surveillance. And look, this isn't some kind of science fiction movie. This is the reality of tax compliance today. As we're about to see, the taxman has gone digital in a very, very big way. Okay, so at the very heart of all this is a system called Connect. The best way to think of it is as HMRC's own digital detective. It's a massive 80 million pound data matching powerhouse, and it has one simple job: to find any gaps between the lifestyle you appear to be living and the income you're actually telling them about. And this really shows the new reality perfectly. It's no longer about a single inspector sitting down to review your file. Connect does this automatically on a massive scale. It sifts through your entire digital and financial footprint to build a profile, and it flags anything that just doesn't quite add up. And just look at the sheer amount of data sources they're pulling from. I mean, we are talking about everything, from your UK bank accounts to financial data from over 100 other countries. It sees your property sales through the land registry, your company records, and yes, even your social media posts. Let me give you a real-world example. Imagine you're a freelance web designer living in London. Connect sees the income you've declared, but it also sees from the land registry that you've just bought a new flat, and it might even notice your posts on social media about that brand new, expensive bit of tech you bought. If those dots don't connect with your declared income, boom, you get flagged. And this isn't just us speculating, this is a direct statement from HMRC themselves. They've confirmed that AI is being used to find these inconsistencies. Now, they do stress this is for targeted criminal investigations, not for snooping on the average person. But it just goes to show you how powerful this technology is and how seriously they're taking that digital trail we all leave behind. So, how does this digital dragnet actually work in practice? Let's follow the digital money trail. We're going to look at a few examples of income you might think is totally hidden, but, well, it really isn't anymore. You know, the age-old myth was that cash is king because it's untraceable. Well, that is a really dangerous myth to believe today. Even if you get paid in cash, making large or regular cash deposits into your bank account can trigger an alert. Or let's say you're a builder. HMRC can look at data from your suppliers. If they see you're buying thousands of pounds of materials but only declaring a tiny income, that's a huge red flag for them. Here's a pro tip for you, especially for the modern age. A lot of people believe cryptocurrency is like the digital Wild West, totally anonymous. It's not. HMRC has agreements with major crypto exchanges to get user data. They have been actively sending out what they call nudge letters to people they suspect of having undeclared crypto gains based on this exact data. Stay with me. This next point might surprise you. Even really savvy investors need to be careful. Physical gold, like the Gold Britannia coins, can be very attractive because here in the UK, they're exempt from capital gains tax. But, and this is the crucial part, that tax-free status doesn't make the transaction invisible. A large purchase of gold from a bullion dealer still creates a paper trail. If HMRC can't see where the legitimate declared funds came from to buy tens of thousands of pounds of gold, you can bet they're going to start asking questions. Okay, so we've seen how they can find you. What happens when they do? This is where things can get very, very serious very quickly. Let's take a look at the formal investigation process. When things get serious, HMRC has two main paths. The first is Code of Practice 8, or COP 8. That's for complex tax avoidance. Think offshore schemes and the like. It's a civil matter, but it's still incredibly serious. COP 9, though? COP 9 is on a whole other level. This is what they issue when they suspect serious tax fraud. The critical difference is that COP 9 offers you a deal. Come completely clean about everything, and you can get immunity from criminal prosecution. It is your one and only chance to avoid a criminal investigation. A COP 9 notice is probably the most serious letter a taxpayer can ever receive. It's basically HMRC putting all their cards on the table. They are telling you, we suspect you of fraud, and they are giving you a choice with absolutely life-changing consequences. Cooperate and tell us everything, or reject our offer and face a potential criminal investigation, which, yes, could lead to prison time.
And that choice comes with a very, very strict deadline. The moment you receive that COP9 notice, a 60-day clock starts ticking. Within that window, you have to formally accept or deny their offer. If you miss that deadline or just fail to respond, HMRC can simply pass your case straight to their criminal investigations team. The stakes honestly could not be higher.
And there's another powerful tool in their arsenal, the Unexplained Wealth Order, or UWO. This completely flips the usual burden of proof on its head. So instead of the authorities having to prove your assets came from crime, a UWO forces you to prove they came from a legitimate source. If you can't explain how you afforded that multi-million-pound property portfolio, they can seize it. So we've covered the investigation, but what's the actual price of getting caught? Well, the financial penalties can be absolutely staggering. That's not all. Here's where most people go wrong and just how costly it can be. The penalty you pay all depends on your behavior and, crucially, whether you came forward or waited for HMRC to find you. An error can be careless. Maybe you just failed to take reasonable care. Deliberate means you knew you were underpaying tax, and deliberate and concealed means you knew and you actively took steps to hide it. Just look at the difference. A simple careless mistake you volunteer can have a 0% penalty, but a deliberate and concealed error that HMRC finds could carry a penalty of up to 100% of the tax owed. So, a £10,000 undeclared tax bill, that could instantly swell to £20,000, and that's before they even add interest. Now look at this number, 200%. That is not a typo. When it comes to certain offshore matters, HMRC's penalties are designed to be extremely severe. A 200% penalty means that for every £1 of tax you evaded, you could be forced to pay back £3 in total. The original pound of tax, plus a £2 penalty right on top. And the consequences, they're not just financial. If the tax you deliberately defaulted on is over £25,000, HMRC has the power to publish your name, your address, and your business details for everyone to see. This is public naming and shaming, and the damage to your reputation can be absolutely devastating and permanent. Okay, that covers the risks, and I know it's a lot to take in, but after understanding the stakes, what is the right way forward? Let's switch gears and talk about the strategy that keeps you on the right side of the law. The most crucial point really is to be proactive. The single most effective way to reduce penalties is through what's called an unprompted voluntary disclosure. That means you approach HMRC and admit an error before they have any idea something is wrong. Always take reasonable care, keep good records, get help if you're not sure, and that leads to the most important point of all. Get professional advice. The tax system is incredibly complex, and an expert can help you navigate it the right way. Ultimately, it all comes down to this. You do not want to wait for that brown envelope to land on your doormat. Because by the time HMRC contacts you, your options are already limited, and the potential costs are so much higher. Your strongest defense is getting things right from the start, and your best strategy is taking expert advice now. So if anything we've talked about today has raised questions for you, you can get in touch with the very experts who developed this briefing at My Tax Accountant. Their details are right there on the screen for you. I'd also highly recommend you subscribe to their YouTube channel for more essential insights just like this one. And finally, just a quick disclaimer, the information here is for general guidance only. Tax is a complicated business, so for advice that's tailored to your specific situation, you must consult with a professional. Thanks so much for watching.